At first, nothing feels wrong. The streets are full, stores are open, markets are calm, people go to work, pay their bills, plan vacations, argue about politics, complain about prices. Life looks normal, almost boring. And that's exactly how every debt collapse begins. Because debt doesn't announce itself with explosions. It doesn't arrive with panic. It grows quietly, buried under numbers most people never look at. Balance sheets, government reports, long-term obligations written in small print. At the beginning, debt feels helpful, necessary, even harmless. Borrowing fuels growth. Credit expands businesses. Governments spend to stabilize crises. Central banks promise control. Everything sounds reasonable, responsible, even, and for a while it works. The system looks stable. Confidence rises. Asset prices climb. People feel richer, even if they haven't actually produced more. Debt quietly replaces real growth. That's when the illusion becomes dangerous, because debt doesn't disappear. It accumulates. It compounds. It stacks layer upon layer, year after year, crisis after crisis. Every empire that ever collapsed followed the same path. Rome didn't fall because of one invasion. It collapsed under centuries of unpaid promises. Soldiers paid with diluted coinage. Infrastructure funded with borrowed money. An empire spending more than it could extract from reality. By the time people noticed something was wrong, daily lives still looked normal. Markets were open. Trade continued. Politics carried on. But beneath the surface, the system was hollow. Fast forward to modern times. The same pattern repeats. Different language. Same structure. Debt grows faster than income. Governments roll over old debt by issuing new debt. Corporations survive not by profits, but by refinancing. Entire economies depend on interest rates staying artificially low. And everyone agrees to look away. Because as long as markets don't crash, it feels safe. As long as payments can be made, the numbers feel abstract. As long as confidence holds, nothing appears broken. This is the most dangerous phase. Not collapse, stability. Because stability built on debt trains people to ignore warning signs. Rising deficits are normalized. Emergency measures become permanent. Trillions turn into rounding errors in public discourse. At this stage, debt is no longer a tool. It becomes a system itself. And once that happens, there are only three possible outcomes. 1. Default. The debt simply cannot be paid. 2. Inflation. The debt is paid, but with money that's worth far less than when it was borrowed. 3. Repression. Capital controls, forced buyers, frozen assets, rules that quietly trap wealth inside the system. Every historical collapse chooses one of these paths. Sometimes all three. But before any of them happen, there's always denial. In the late stages, the numbers become too large to emotionally process. Hundreds of billions, then trillions, then numbers so large they lose meaning. People stop asking who will pay. They stop asking when. They stop asking if it's even possible. They focus instead on short-term calm. Politicians promise stability. Experts explain why this time is different. New theories emerge to justify why debt no longer matters, why ratios can rise forever, why growth will magically catch up. This is not ignorance. It's psychological comfort, because accepting the truth requires accepting change. And change threatens routines, savings, status, and assumptions built over decades. So societies choose comfort. They ignore the numbers. They ignore the trajectory. They ignore history. And as long as nothing visibly breaks, the illusion holds. But debt doesn't resolve gradually. It resolves suddenly. Not when the debt becomes large, but when confidence disappears, when lenders hesitate, when buyers demand higher yields, when central banks lose credibility, when the cost of maintaining the illusion becomes higher than the cost of admitting failure. That moment never feels predictable in advance. But looking back, it always feels obvious. The charts were there. The warnings were public. The math was unforgiving. Debt didn't end differently this time. It ended the same way it always does. And the people who suffer the most are never the ones who created it. They're the ones who trusted stability, trusted institutions, and trusted that normal meant safe. By the time reality forces a correction, the options are gone. And that's when people finally ask the question they should have asked years earlier. What actually survives when debt collapses? Debt doesn't become dangerous when it's large. It becomes dangerous when it stops being optional. In the early phase, debt is a choice. Governments borrow to smooth cycles. Companies borrow to expand. Individuals borrow to accelerate their future income. There's flexibility, margin for error. But slowly, almost invisibly, debt crosses a line. At that point, borrowing is no longer used to grow. It's used to survive. Old debt is paid with new debt. Interest is serviced, not reduced. Refinancing replaces repayment. The system keeps moving, but only because it cannot afford to stop. This is the moment when debt becomes structural. You can see it in the numbers long before you feel it in daily life. Debt grows faster than GDP. Deficits persist even during economic expansions. Emergency measures introduced during crises are never rolled back. Central banks intervene not to stimulate growth, but to prevent collapse. Rates can't rise without breaking something. Spending can't fall without triggering instability. The system becomes fragile, not because it's weak, but because it's stretched too far. Historically, this is when governments begin to lose control over outcomes. They still control narratives, press conferences, policy language, forecasts, but they no longer control consequences. In Weimar Germany, debt from war reparations made fiscal balance impossible. Printing money felt like the least painful option until it wasn't. Prices rose slowly at first. People adapted. Then confidence snapped, and money became meaningless almost overnight. In post-war Britain, debt didn't collapse through hyperinflation, but through decades of currency debasement and capital controls. Wealth didn't vanish instantly. It eroded quietly, year after year, until the country emerged smaller, poorer, and less influential. In the United States during the 1970s, debt deficits and monetary expansion collided with oil shocks and stagnant productivity. Inflation became the release valve. Wages lagged. Savings dissolved. The illusion of stability cracked. Different countries. Different decades. Same structure. Debt reaches a level where honest repayment becomes politically and mathematically impossible. From that point on, the question is no longer if debt will be resolved, but how. And every resolution transfers pain. Default transfers pain to lenders. Inflation transfers pain to savers and wage earners. Repression transfers pain to anyone trying to protect capital. There is no painless exit. What makes this phase especially dangerous is how normal it feels. Markets still function. Banks still operate. Government bonds still trade. Headlines focus on short-term movements instead of long-term trajectories. People are trained to look at volatility, not direction. They worry about recessions, not solvency. They fear crashes, not slow decay. This is why debt collapses almost never look dramatic in advance. They look boring, technical, buried under jargon, until suddenly one small shift exposes the entire structure. A failed auction, a spike in yields, a currency that weakens faster than expected, a central bank forced to choose between credibility and stability. Once confidence breaks, it doesn't return easily. And here's the critical detail most people miss. By the time debt becomes a public conversation, it's already too late to fix it cleanly. Solutions at that stage are not preventative. They are damage control. This is when governments start talking about extraordinary measures, about temporary policies, about necessary adjustments. History shows what those words usually mean. Currency dilution, forced participation, quiet rule changes that trap capital inside the system. None of this requires panic. In fact, panic is avoided deliberately. The goal becomes maintaining the appearance of order for as long as possible. Because the longer the system looks stable, the more people stay invested in it. And the more people stay invested, the easier it becomes to transfer losses without resistance. This is why debt always ends the same way. Not because leaders are evil, but because the structure leaves them no alternative. Once debt dominates the system, every decision prioritizes survival over truth, and survival always comes at the expense of someone else. By the end of this phase, the system still exists, but it no longer serves the same purpose. It stops protecting wealth and starts extracting it, quietly, gradually, legally, which leads to the most important question of all. If debt collapses are inevitable, if stability is often an illusion, if systems protect themselves before they protect people, then how do you recognize when you're already inside the final phase? And more importantly, what actually holds value when debt stops working? Every major collapse shares one uncomfortable truth. Right before things break, they look stable, not calm, not prosperous, just normal. People still go to work. Stores are open. Markets fluctuate but recover. Governments reassure. Experts explain. Life continues with minor inconveniences that are easy to rationalize. This is a phase where danger hides in plain sight. Historically, the final stage before collapse is not chaos. It's normalization. In 1928, newspapers praised American productivity and innovation. Stock prices dipped occasionally, but confidence was absolute. The system felt modern, advanced, and resilient. Warnings were dismissed as outdated thinking. In the late 1990s, technology stocks were redefining the economy. Valuations didn't matter anymore, or so it was said. A new paradigm had arrived. When the crash came, it shocked people precisely because nothing felt fragile the year before. In 2006, housing prices slowed slightly. Analysts called it a soft landing. Mortgages were everywhere. Credit was abundant. Ownership felt safe. Then defaults rose, leverage unwound, and the entire financial system froze within months. What makes this stage so deceptive is that the signals are subtle. Debt doesn't explode overnight. It creeps. Governments don't announce failure. They adjust language. Central banks don't panic. They reassure. You don't see collapse. You see optimization. Rules change quietly. Definitions are updated. Targets are reframed. Emergency tools become permanent. This is when financial systems start behaving defensively, even if no one admits it. Interest rates are held lower than inflation. Debt ceilings are raised without debate. Deficits are described as investments. Money creation is justified as stability. Each decision makes sense in isolation. Together, they form a pattern that has appeared before every major breakdown. Another hallmark of this phase is moral hazard. Losses are absorbed upward. Risks are socialized. Failures are rescued. Successes remain private. This doesn't cause outrage immediately. It creates complacency. People learn that the system will intervene, that markets won't be allowed to fall too far, that institutions are too big to fail. And for a while, that belief seems correct, until the scale becomes unmanageable. At that point, interventions no longer solve problems. They only delay them. Confidence begins to erode, not dramatically, but quietly. Foreign buyers demand higher yields. Currencies weaken gradually. Capital flows become erratic. Savings lose purchasing power year after year. Still, nothing feels urgent. This is why collapses are rarely recognized in real time. They're only obvious in hindsight. When historians look back, they point to moments that seemed insignificant at the time. A policy change, a market signal, a dismissed warning. But for people living through it, those moments blended into the background noise of daily life. That's the real danger. Collapse doesn't announce itself with sirens. It arrives disguised as normalcy. And by the time fear replaces routine, the options are already limited, which leads to a critical distinction. There's a difference between volatility and vulnerability. Markets can fall and recover. Currencies can fluctuate and stabilize. But when trust in the system's foundation weakens, recovery becomes cosmetic. The surface improves. The structure doesn't. This is when people start asking the wrong questions. They ask when things will go back to normal, not realizing that normal was a problem. They wait for clarity, not understanding that clarity only comes after damage. They hold assets designed for stability inside a system that can no longer provide it. And this is where the final phase begins, not with collapse itself, but with the realization that the rules have changed, silently, permanently. And once that realization spreads, the unwind accelerates faster than anyone expects. What makes modern collapses especially dangerous is the illusion of sophistication. Today's systems feel more advanced, more regulated, more data-driven, more controlled. Algorithms manage markets. Central banks coordinate globally. Governments communicate instantly. Risk is modeled, quantified, stress-tested. On the surface, it feels impossible for history to repeat itself. But complexity doesn't eliminate collapse. It disguises it. In fact, the more complex a system becomes, the harder it is to unwind safely. Modern economies are built on leverage layered upon leverage. Debt isn't just government-issued. It's embedded in corporations, households, derivatives, pension systems, and shadow markets most people never see. Each layer depends on the one beneath it, holding steady. When confidence slips at the base, the entire structure vibrates. What's different today isn't human behavior. Fear hasn't changed. Incentives haven't changed. Power hasn't changed. Only the tools have. Instead of gold reserves, we have balance sheets. Instead of bank runs, we have liquidity freezes. Instead of currency devaluation, we have purchasing power erosion. The outcome is the same. It just unfolds more quietly. Another modern illusion is speed. Information travels instantly. Markets react in milliseconds. Capital moves globally in seconds. This creates the impression that problems will be detected and solved faster. In reality, it does the opposite. Speed compresses reaction time. When trust breaks, it doesn't spread slowly across borders. It cascades. That's why recent crises don't unfold over decades. They unfold over months, sometimes weeks. And when they hit, authorities respond the only way they can. They add liquidity. They expand balance sheets. They suspend normal rules. Again, each action feels rational in the moment, but together, they shift risk from visible places to invisible ones. Inflation replaces default. Currency weakness replaces restructuring. Asset bubbles replace growth. The system keeps moving, but at the cost of stability. This is why modern collapses feel confusing. There's no single breaking point, no dramatic announcement, no official admission. Instead, people feel it gradually. Rent rises faster than wages. Savings buy less each year. Assets inflate beyond reach. Debt becomes permanent. What was once temporary becomes structural. And this is a critical mistake most people make at this stage. They assume the system will correct itself. They believe incentives will realign. They expect reforms to restore balance. But historically, systems burdened by excessive debt don't reset smoothly. They resolve through one of three paths: inflation, default, or restructuring disguised as stability. Every time, the details change. The mechanism doesn't. And when the resolution finally arrives, it doesn't punish everyone equally. Those holding assets tied directly to the system absorb the shock. Those holding assets independent of it remain insulated. This is why wealth doesn't disappear in collapses. It transfers, quietly, predictably, from those who trusted the system to those who understood its limits. Which brings us to the final and most important question. If collapse doesn't look like chaos at first, if it feels normal until it's irreversible, and if modern systems fail the same way as ancient ones, where does that leave you? That answer depends entirely on what you're holding when confidence finally breaks. By the time collapse becomes obvious, it's already too late to react. That's the part history makes painfully clear. People don't lose wealth when panic hits the headlines. They lose in the years before, while everything still looks normal, when systems are overstretched. The danger isn't sudden chaos. It's quiet erosion. Debt doesn't explode overnight. It accumulates silently. Currencies don't fail instantly. They weaken gradually. Institutions don't collapse in a day. They hollow out over time. And during this phase, most people make the same assumption. They believe stability equals safety. But stability is often the final stage before adjustment. Empires don't fall when people expect them to. They fall when people trust them the most. That's why collapse rarely feels dramatic at first. It feels bureaucratic, managed, technical, boring, until the consequences become unavoidable. This is why understanding patterns matters more than predicting dates. No one needs to know exactly when the next break will happen. History shows that knowing how systems fail is enough. Because once you understand mechanics, you stop reacting emotionally. You stop chasing noise. You stop assuming permanence where none exists. Instead, you start thinking differently. You evaluate assets based on resilience, not performance. You value independence over convenience. You prioritize durability over growth stories. This shift doesn't require panic. It requires clarity. The people who preserved wealth during past collapses didn't do anything extreme. They didn't predict headlines. They didn't time the market perfectly. They simply positioned themselves outside the weakest points of the system. And that's the real takeaway. Collapse isn't about fear. It's about exposure. The more dependent you are on a single system functioning perfectly, the more vulnerable you become when it doesn't. And systems, by nature, always change. So the question isn't whether another collapse will happen. History already answered that. The real question is whether you'll recognize it while it still feels normal. If this way of thinking resonates with you, if you want to understand how wealth behaves when systems strain and incentives break, then stay here. This channel exists to uncover those patterns, not to predict disasters, not to sell panic, but to help you see what history keeps repeating before it becomes obvious to everyone else. Because by the time collapse feels real, the decisions that matter were already made. And the people who understood that were never surprised when it finally arrived.